So on this table in front of you is literally about 140 years worth of investment and financial planning experience, right? So it's a great team with one exception, and I'll let Paul introduce him. This is the AFMA Wealth Management and Trust team, part of it, that manages the part of the 1.3 billion in assets that you heard about over there at the annual meeting. So this is the team that does that with some other folks. For our individual clients, manages that today about $190 million in assets for all of them. So I love working with them. These folks are awesome. And they look forward to hopefully providing you some insights about current markets, questions you may have, and also the services that we provide. So hopefully you walk away from here with at least one new nugget of insight or information that you didn't have when you came here. First time we've done it in this format, and they're probably going to tell you to hold questions to the end. Don't be shy. There's not a lot of us in here. If you have questions, don't be afraid to ask. I will introduce Paul. So 40 of the 140 years of experience belongs to our Chief Investment Officer, which is something he should be proud of because I'm proud to work with him. He's built a great team. So I've got to get over to the board meeting, but I just wanted to do that quick introduction. He's built a great team. I think you're going to see some of that today. And poke them, ask questions. Don't be shy. Thanks. Paul.
Thank you very much, Steve. With that introduction, I think I'm going to start counting my age backward from this year. But yeah, it really is a pleasure to be here with everyone and with my distinguished colleagues at AFMA Wealth Management and Trust, and with Seth, who I'm going to talk about in a minute. I want to start by laying some context. And as we all know, too well, actually, we live in very interesting economic, political, and actually also geopolitical times. And as we were thinking about what we wanted to talk about on the roundtable today, there were so many topical subjects that we had to choose very carefully what we wanted to actually talk about. And we decided to begin with a focus on the recent market, what's gone on this year so far, especially when you think about how strong 2023 was. And also there's a bit of a unique economic backdrop that we want to cover as well. And then I think it's going to be a natural transition, but we'll begin to talk about inflation, inflation's impact on our portfolios, and not just from an investment perspective, but how should all of us incorporate inflation into planning for our financial futures. We've had a number of questions from clients on how worried we should all be about the growing level of U.S. debt. So we're going to talk about that a little bit. And we also wanted to talk about something that we get asked a lot about as well. How do we view international markets, particularly equities, but potentially also fixed income? And how do we allocate investments to the U.S. versus, say, international? And then we're going to touch on housing affordability and another subject that we think is relevant to individual investors, and that's tax optimization. What place in our portfolios does tax optimization have? How do we incorporate that into financial planning? And then to wrap things up, we'll do a very quick round of forecasts on really any specific topic that my colleagues are interested in for the end of the year. I'd like to take the opportunity now to introduce the panel And I also want to recognize one of our important team members who's sitting in the audience, Peter St. Dennis, Senior Portfolio Manager, and as I said, a key team member. So in no particular order, well, I'm going to start with Parker King at the end of the table. Is a quantitative research and risk management strategist. Parker has 30 years of industry experience, which include roles in trading, quantitative research, portfolio management. Parker served in the U.S. Army with tours in the 2nd Infantry Division and the 75th Ranger Regiment. Next, Kristin. Kristin Ketner is a senior portfolio manager. Kristin is an accomplished investor with more than 30 years of experience in the financial markets, including roles in equity research, portfolio management, and investment banking. In her role with us, Kristin is responsible for constructing, implementing, and managing client portfolios. And Kristin was born and raised in Indiana before moving to the New York City area where she's based today to pursue her career on Wall Street and ultimately with AFMA. Brittany Benassi is the head of our financial planning team. I think many of you undoubtedly know her already. She and her team work closely with our clients to help them define their goals and design comprehensive plans to achieve them. The financial planning team produces customized plans for each of our planning clients and stress tests those plans with a number of personal and financial scenarios that include both inflation considerations and tax considerations, among others. And finally, we are really extremely pleased to have Seth Rosenthal on our panel. Seth is the Chief Investment Officer at Academy Asset Management, which is a disabled, veteran-owned asset manager with a complementary social mission to support the military community. Seth was previously the bank chief investment officer at Northern Trust. And in his 16 years there, he oversaw $100 billion, yes, billion in global fixed income and money market assets across a range of duration and credit mandates. Prior to Northern Trust, Seth spent 10 years at the Bank of Montreal Harris, holding various roles in treasury and credit analytics. So I'd like to get into the substance of the roundtable, and we'll start with Parker, Seth, and Kristin. And here's my question. The Federal Reserve famously has a dual mandate to manage inflation and unemployment. It seems like the past year or two have really taught us why both are important. Can you start us off by talking a little bit about the current economy and how the markets have performed so far this year, especially, as I said before, following the strength of 2023? And Parker, if it's okay with you, maybe you can start us off.
Okay, sure. I think at the end of Q4, we had a webinar and we discussed, what's the potential for next year? And, and we thought we could have an average year. We thought it's possible that this could be a 10% up year in the S&P 500 and U.S. large cap equities. I wouldn't have guessed that we'd be sitting here at the end of May and we're already up 11%. Pretty amazing. This year, it's not just the S&P 500. If you look to Europe, the DAX is up. The German equity market, the DAX is up 10%. The FTSE 100 is up 7%. And believe it or not, the strongest of the major markets is in Japan, the Nikkei 225, which is up 15% year to date. So really still a strong global equity market. Some of the themes from last year are persisting. If we look at what sectors were strong, the strong sectors, communication services up 15%, tech up 12%. So a lot of the themes from last year are still carrying on into 2024. Couple of things that are lagging. Emerging markets only up 5%, and in spite of a lot of you see a lot of talk out there about transitioning of small and mid cap. Mid cap's up about 7% this year, and small cap's only up about 1.5%. So in spite of valuation, we haven't really seen that shift out of large cap into smaller mid cap so far this year. If we look at bonds, bonds have been kind of neutral. We've had a backup in bond yields this year. I think U.S. 10-year started the year under 4%, and I think after last week's non-farm payroll, we backed up to about 4.40 on the 10-year. So if we look at so our preferred benchmark, the Bloomberg Intermediate Gov Credit, it's down about 30 basis points this year, so about flat in bonds. In terms of economy, I think a lot of the themes are tending to persist. Within the U.S., inflation is decelerating, but it's still sticky. Global growth is good. The labor market U.S. growth is strong. Labor market is still strong. So one of the things is, how is that translated into interest rates? And there's been an expectation of a rate cut, and it keeps getting put off. I think after the non-farm payroll number, there's almost no chance of a rate cut in July. It's being pushed off into either September or November. So I think what the market's really looking at, as long as there's the expectation of the cut out there somewhere, we're not transitioning into a rate hike environment. I think the equity market's going to be well supported. But at least from our perspective, in that environment, we want large cap companies with strong balance sheets, companies that can weather this kind of higher interest rates for longer environment. On the fixed income side, in that sort of environment, I would say we're less like we see U.S. Sovereign bonds as less interest. If you go outside the United States, if you look at the UK, if you look at Europe in general, you've got a little bit softer growth. You've got expectations of rate cuts, and we saw last week the European Central Bank cut interest rates 25 basis points. So that's recently been delivered. So we see some in terms of sovereign bonds, we see some better opportunity outside the U.S. in say the UK, Australia, Canada, and I think just in terms of market return and kind of general global economic environment, that's kind of my take.
Seth, do you want to provide some of your thoughts on fixed income?
Well, Parker did a good job covering. Our expertise is in the fixed income space, so Parker covered the vast majority of that. I'd say, just thinking about the Fed's dual mandate, you've got unemployment, full employment, and then price stability. And on unemployment, we're hovering, 4% or lower, and on price stability, that's the big challenge in them trying to bring that down, and that's really the big driver. That is, or a good portion of that, and we'll get into it, is some of the owner's equivalent rent, which is a big component of the inflation number. So is that, we think that will come down over time, but they're really struggling on that last mile of bringing inflation down. So because they can't do that, Parker talked about rate cuts being off the table. We started the year at 100, expecting 150 basis points of cuts, and now we're at less than, call it 1.5. And quite frankly, we'll see what happens with the Fed, but that could be fully priced out if they can't get inflation down. In terms of Other things I would add is, we are watching things, and we'll get further into it, but there are some, I would say, dark clouds on the horizon, particularly commercial real estate. We're seeing banks increase their reserve positions, which, at least some of the larger ones are seeing it, and you're not seeing it in the small to mid-size, which is where probably the big pain points could come from. But and then the other component is consumer. The consumer has been holding in there extremely strong. But what we are starting to see is, elevated credit balances, increasing delinquencies. And so, that's just one thing that we're watching. The consumer, to our surprise at Academy, is, we thought at least at some point they would fall out of bed. But we're living in this, you only live once. They call it YOLO. And it just it's just shocking to me that people continue to spend, because we definitely know at the bottom end of the income distribution, the level of inflation has been really biting. So with that, I'll turn it over back to you, Paul.
Great. Thank you. And Kristin, your thoughts?
Yeah, I don't have much to add, but just from an equity perspective, as Parker said, yeah, the S&P is up 11, 12% year to date, which historically is kind of slightly higher than an average annual return. So the market has done very well. And then just peeling back a little, as Parker referenced, the sectors you would expect are driving the market. Tech, tech's up 17%. Actually, communications services, which contains some techie companies, Meta/Facebook, Google/Alphabet, and Netflix, is actually leading the market up over 20%. You might find this surprising, but the third sector that's leading the market is utilities, up 16%. And ironically, I'm sure you've all heard of the artificial intelligence theme. Media talks about it quite extensively, is actually driving tech and communication services and utilities. It seems that these AI data centers require a lot of power. And so people are investing in utilities in the anticipation of a lot of power needs. The biggest AI beneficiary to date, though, I'm sure you've heard of NVIDIA. It's up nearly 150% this year, and has hit the 3 trillion market cap club. And that stock has accounted for a third of the returns of the S&P year to date, which is astounding. But it's substantiated with fundamentals. Their earnings have quintupled in the last 12 months. So a phenomenal story, but seemingly the one who's capturing all the spoils of artificial intelligence right now is NVIDIA.
Thank you. And there were 2 points you made that I thought were great. One is utilities and the amount of power that AI is going to soak up. And then on NVIDIA, I mean, the way I visualize that is that out of 500 companies in the S&P 500, one of them contributed a third of all of the returns year to date. The other 499 contributed 2/3. So, I mean, that's just incredible. So with the backdrop that we've created so far, I wanted to focus in a little bit more on inflation. And look, the Fed has made progress. Inflation at its peak following COVID hit 9.1%. We're down in the, plus or minus 3% range today. But investors should be thinking about it. All of us in the room should be thinking about inflation. We know, as an example, inflation erodes the value of retirees' assets. That's an important issue. And it's not just true for individual investors, it's true for many institutional investors, especially nonprofits and foundations. Seth, I thought maybe we could start with you, and maybe you can talk to us a little bit about how you incorporate inflation into your strategy. And are there any upside opportunities given where we are?
Yeah, so first of all, just kind of unpack the inflation component, and thinking about, how inflation impacts fixed income. So the first is just interest rate risk. So when you've got we all know that when you have rising or increasing inflation, you have a lot of interest rate volatility and rising interest rates. So that interest rate risk that you have, if you bought the 10-year before inflation started to spike, you were stuck with that, and so you had a negative or a loss position on that. So there's the interest rate component that impacts. The second component is real interest rates. So when I say real interest rates, that's really the interest rate that you're earning after inflation, and so that is dramatically impactful. And so Paul referenced 9% that we saw in June of 2022. I don't know if anybody wants to guess what the 10-year Treasury was at the time of that, but it was 3%. So you're talking about real yields at that particular time of -6%, which has a pretty big impact. So for us, we think about that, but it's also thinking about what is the market's expectation for interest rates relative to your own personal view, and putting a couple things in perspective. So over the next 10 years, the market's pricing in, call it 2.25, a little more than that in terms of expected inflation. But pre-COVID, we were sitting closer to 1.5 to 1.75. So obviously, overall, just given everything that's been going on, we've seen an elevated inflation expectations. So what we do is we say, okay, today's the market's expectations over the next 10 years, 2.25. We think eventually it will come down. I think there's a lot of factors coming into play economically. Technology that we talked about, you brought up with AI. We think there's a lot of benefits there, and we think that can come down. It just in the near term, we think it still will remain elevated, but over the long run, we think it can come down. So we think that there is some benefit there.
Thank you. Kristin, are there companies or maybe sectors, industries that actually have a competitive advantage in an inflationary environment? And so the part two of that question is, if inflation is going down, how do we think about that as well?
Yeah, sure. So we have model portfolios at AppNet Wealth Management and Trust, and we like to invest in companies that have dominant market share positions, innovative companies, growthier sectors, and these are companies that tend to have more pricing power. Pricing power is very important, and it comes into play in inflationary periods, deflationary periods, and disinflationary periods, kind of what we're going through right now. So what the pricing power enables companies to do is when inflation is going up in their cost structure, they can price through and preserve their margins is the hope. And then if inflation comes back in, disinflationary or deflation, they have a better chance of retaining that pricing and may actually have the potential of expanding margins. So that's the power of pricing. So we want to invest in companies that have that kind of pricing power. So I guess the dirty little secret is that inflation can be good for companies that can price in inflationary periods.
Great, thank you. Brittany, Seth and Kristin talked a little bit about the investment considerations related to inflation. How do we incorporate inflation in a different context into financial planning at a much more client-specific level?
Yeah, absolutely. So obviously inflation has been a concern for many of our clients the last few years. It impacts cash flow, investments, and savings. And incorporating normal levels of inflation is obviously essential in a financial plan, but even more so in a high inflationary environment. I would say the benefit of having a financial plan is really to be able to see a client's entire financial picture, seeing how all the puzzle pieces are fitting together, and giving us an idea of opportunities for optimization. And understanding the impact of economic environments, right, like high inflation. It also gives us the opportunity to see what risks there are in a client portfolio and stress test those risks to really understand where there's opportunities for course correction. So in the short term, we've been helping clients with cash flow management, which isn't just budgeting and understanding expenses, but it's also thinking about things like saving strategies, right? Like Seth mentioned, a higher interest rate environment makes cash a little bit more productive. So making sure clients are keeping their cash productive to fight against that inflation, navigating higher borrowing costs for clients. So higher rates of interest for real estate, higher car loans, higher student loans for their kids, things like that. And helping clients understand the impact of reducing savings. So some clients have had to adjust their saving strategies, adjusting their savings amounts in order to keep their cash flow positive during these times. And so developing a long-term plan to help achieve those goals and helping them really understand the impact of reducing savings by X dollar will have XYZ impact. But then there's also tax consequences. Tax impact of cost of living adjustments may increase clients, tax impact, tax consequences. So helping them navigate that is something we've been doing. And as Kristin mentioned and pointed out, asset allocation and how we compile our portfolios in this high inflationary environment is also impactful. So we do that as a team here at Affluent Wealth Management and Trust. I'd say, but the bottom line is everybody's financial plan and financial circumstances are very different, and how you deal with inflation can be very different depending on, their personal financial circumstances.
Right. Thank you, Brittany.
Yep.
I just want to add one thing. It's interesting because we're focused mainly on, regular investors, people in the room, but it does, as I said before, inflation does have an impact on nonprofits and foundations. They have an analogous financial planning challenge. Unlike a lot of corporations that have an investment objective to generate higher returns than, say, their cost of their liabilities or their expenses, nonprofits and foundations often need to outperform inflation to protect their ability to offer meaningful, low-cost loans or grants to people in need. And that's a different kind of investment problem, and one that we're not sure that many larger asset managers appreciate. Given our peer group of institutions, our partners, as an example, that are supporting the military community, we have actually thought quite a bit about this. It's a discussion for another day, but one we'd love to have with anyone, that might be interested. So let's move on. Let's talk a little bit about U.S. debt and the cost of servicing that debt. It's not a new concern, but we do hear people concerned about how quickly U.S. debt has been rising, what it costs as taxpayers to pay for that debt. I'm just going to be really blunt to the panel. Is it worth stressing over? And Seth, maybe you can kick off our thoughts on this.
Okay. It's like the third rail. So let me just put a couple things in perspective. So the U.S. debt to GDP is about 122%. But you compare that to, say, Japan, which is at 225%. Now, they're still continuing to function. They're in a little bit different situation than us, but just kind of park that for a minute. And then let's look at the government spending component. So right now, the cost of service debt is called 12 to 13%. That's on parallel with defense spending at 13, and it's doubled though recently. And I think that's the point that Paul is trying to raise. As we look forward, according to the CBO, the total government spending is expected to increase 3.5 trillion over the next 10 years. And that's coming from three categories: healthcare, Social Security, and interest costs. So obviously that, adds to the alarm. I think the other thing that we have at play is, the U.S. The short answer is, in the intermediate term, short and intermediate term, I don't think there's reason to be concerned. You look at kind of us relative to Japan, not that we want to get there, but that's, kind of one component to think about. And then, we continue, the U.S. stands as the world's reserve currency. And so because other central banks are parking assets in high quality, U.S. denominated assets, such as U.S. Treasuries, we almost have that natural buyer base. Now, admittedly, that is declining. We're seeing, some central banks or, some banks move their reserves into gold and other assets. So, we're seeing a migration away. We're not at that catastrophic point, but it's just something worth watching. So my point is, in the intermediate term, I'm not that concerned about it. In the long run, the spending is out of control. And at the end of the day, you look at where we were 5-10 years ago, and in, the path that we're on, if it doesn't stop, then I start to get to concern. But that's more of a longer term situation.
And it seems like it's more of a government spending and taxation question than necessarily a market issue. And there are a lot of opinions, strong opinions on this. But if you look back at the data and you think about the equity market, there's really very little correlation between high levels of government debt and poor market returns. And I think that's what people are concerned about. And so one of the things we tell people when they ask us about this is not to make quick decisions or radical decisions to take your money out of the equity market because you have a concern that the government debt is rising. So with that, I'd like to take the discussion in a slightly different direction. Parker commented briefly up front about international markets. And Parker and Kristin, you've both done quite a bit of work recently on how we think about, or let me just say, at looking at the performance of international stocks versus U.S. stocks. And our conclusions might be a little bit contrarian. And so, Parker, can you begin by talking a little bit about that work that we did?
Sure, Paul, and I'll take it a little bit from the kind of top-down macro index level. Just in terms of including international equities, emerging equities, we view it as more of a tactical decision than a strategic permanent decision. If you look at the S&P 500 over the last 20 years, and then you look at international indices, for example, MSCI EAFE's, Europe, Australasia, Far East, and emerging market indices. If you think about, okay, I need to diversify with international equities, one of the things you'll find over the last 20 years is actually the return to EAFE is lower than the S&P and the risk is higher. Same thing with emerging markets. And so when you're diversifying, you're looking, you wouldn't go into something that you know will bring down the return and raise the risk of your portfolio. Sometimes you go into assets if they're negatively correlated during a downturn. But if you look at these indices, both EFA and emerging markets, if you look at them during the great financial crisis, their peak to trough drawdown, or their maximum loss during that period, was greater than the S&P 500. So just adding a slice of an international index permanently to your portfolio, we don't think it makes sense. We think that you want to do it on a tactical basis. And one point I want to make is, a lot of times when people do this research, they said, "Oh, well, you just pick 20 years, and if we go back 100 years, it's a different conclusion. If we look at it over the past 10 years, it's a different conclusion." But that statement I made about how the international slice doesn't diversify over the last 20 years, it's even more dramatic over the last 10 years. And we do think, even though we don't hold slices of international equities on a strategic basis, we do feel like we have a lot of global exposure. And I think I'll pass it over to Kristin to talk about how we get that global exposure through our current portfolios.
So just to be clear, in those stock portfolios that I referenced earlier that we manage, we own predominantly U.S. large cap stocks. And you might be surprised, as Parker said, that over the last 10 years, over the last 20 years, U.S. stocks have outperformed pretty much every market in the world. So fundamentally, you ask yourself, why is that? And it makes sense to us. U.S. companies have the best returns on capital in the world. We have the best capital markets in the world. We have the best regulatory environments in the world. We are the fastest growing developed market of size. And these companies are based here, which is the most profitable market in the world to do business. And it's from that base, that profitable base of business, that they're able to grow globally. And so the U.S. provides a very profitable home base for them to grow. And as Parker said, we if you look across our portfolio, the stocks in the portfolio, on a weighted average basis, those businesses have exposure. 40% of their revenues are outside the U.S. The U.S. companies. We have a couple of international companies, selective themes we've invested in. But 40% of those revenues, and that's similar to what the S&P is, outside the U.S. So you get exposure to international markets, but you're doing it through the U.S. large cap companies, who are the best managed in the world. And as I said, highest returns on capital.
Thank you. Seth, the housing market. Let's talk a little bit about that. It's not directly an investment question, but I suspect that any group of 50 people, 48 of us are thinking about the housing market. So I know that you and Academy have spent a lot of time on this. As I said before, housing affordability is historically low. What are the implications for the markets and for home buyers, and especially for the veteran community?
So, the current levels of mortgage rates that we're seeing at 7% or higher is something we haven't seen in 25 years. And it's an environment that is particularly impactful to those that are new to the housing market. You want to get in, your first mortgage is 7%, and housing affordability is just really, really painful especially for those new folks. I would say it's also locking up, existing borrowers. So the average mortgage rate of existing mortgage borrowers today is 3.5%. So if you're at the average and you want to upgrade, you want to do something different, you're going from 3.5 to 7, which again changes the dynamic. So it's locking up that housing stock. And then just overall, we're starting to see price declines, and there's just a lot. It's holding up the housing market and making it really, really challenging. As it relates to what we're doing for veterans, we actually launched an ETF about a year ago called VETZ, VETZ, and it invests in residential mortgages to veterans and active duty service members. And really, it aligns to our mission at Academy is to support veterans. And so what we've done is we've launched this ETF. It also invests in small business loans to veterans. But as it relates to the residential mortgages, the VA program, which is the underlying assets in the ETF that we have launched, is really, really important for a couple of reasons. And many in this room may be aware, but for those that don't, you think about the benefits of a 0% down mortgage, so 100% LTV, so you don't have to put anything down, lower closing costs, lower interest rate. So all beneficiaries. And then you think about an active duty service member that's in San Diego, right? They don't have that type of may not have the cash to put down. So helping out affordability. And so it's something that we're doing that we are really excited about because, one, it's impacting veterans, but two, it's also, we're providing market-based returns. So we're benchmarked against the Bloomberg MBS index. And, you could look at the Vanguard, the iShares, we're performing right there, but at the same time, we're impacting veterans. And that has helped, we think that will help out veterans in that component.
Thank you. Okay, so last real substantive topic, Brittany, can we talk a little bit about tax optimization and how you think about it or we incorporate it through financial planning?
Yeah, absolutely. Taxes is one of my favorite subjects. So we're always thinking about taxes as financial planners. The Tax Cuts and Jobs Act of 2017, which is due to sunset in 2025, as well as Secure Act, definitely changed the landscape of taxes for the last few years. And as tax law often does, but tax optimization is obviously a large part of financial planning, something we're always thinking about. And again, seeing taxes in a financial plan gives us the ability to see the big picture, right? We can project out, what future tax rates are and current tax rates, and it gives us the opportunity to really think about what it is that we can do given the current landscape and potential future landscape of taxes to try to optimize the client's tax situation as much as possible. So oftentimes we're in partnership with a client's CPA to actually implement those strategies. But things we're talking about right now, and we have been talking about, is, for those who are still employed, active duty, we're always talking about, or not even just active duty, but even in civilian service, is talking about, what tax advantage vehicles they should invest in depending on their circumstance. So traditional versus Roth. Again, seeing big picture really allows us to give some visibility on what's advantageous for that client. For some clients, that's talking about stock options and optimizing their taxes from that standpoint. Also, analyzing strategies is a popular one for the last decade or so, talking about Roth conversions and helping clients walk through that. It's been pretty popular and something we've done quite a bit of lately. And then, of course, those who are charitably inclined, developing a plan for the best way to give from a tax perspective. So there's a lot of opportunities to do that, whether that's gifting appreciated stock, qualified charitable donations, which is done through your IRA, a donor advised fund, or even a charitable trust. So those are things we're often talking about. And then, of course, in terms of asset allocation, ensuring assets are invested in the proper vehicles, given the client's specific circumstances, such as personal risk tolerance, time horizon, tax sensitivity, and income needs. So, yeah.
Great, thank you.
Sure.
Let's go to our lightning round. We'll wrap things up with quick forecasts or observations of the rest of 2024. Let's make our comments short and pithy, a minute each. Parker?
Pithy, okay. So I said no strategic allocation to emerging markets, but I do like India. MSCI India is up 10% this year. I think a lot of the companies, some of the companies there will benefit from the big global companies who are diversifying their supply chain.
Thank you. Kristin.
Oh, 1 minute. We think that GDP growth will slow from here as higher interest rates continue to weigh on the economy. And in the near term, as we've said, the 11-12% move in the S&P is an average annual return. So we think the market's probably sideways from here. But there are some clear investable themes that give us confidence and make us optimistic about the equity outlook for years to come. One is a more specific theme, investing in anti-obesity drugs. Obesity is a global problem. There are medical innovations in medical devices. We have a worldwide aging population. And then the big one that we referenced earlier, investable theme, artificial intelligence, which if it is purported to do what it's purported to do, if it does what it's purported to do, it will drive GDP and productivity for all companies that deploy labor effectively. So right now, NVIDIA is capturing the spoils, but as it works its way through software and through companies' systems, it will drive productivity and earnings growth for years to come.
Thank you. Seth.
So I would say expect high levels of volatility for the rest of the year. We've got a geopolitical landscape that is completely uncertain. We've got uncertainty around where growth, talked about growth, where inflation's headed, and we've got an election. So there's a lot of uncertainty. So we're talking to clients about holding higher percentage of risk control assets, so very high quality assets to offset your risk positions.
Thank you. Brittany.
Yeah, so back to taxes. It's been something that my team and I are thinking about constantly, like I said, but the Tax Cuts and Jobs Act is due to sunset in 2025 if Congress does nothing. So if that sunsets, we may have all forgotten what 2017 tax rates look like, but we will be rudely reminded at the end of 2025 because tax rates are going to increase and revert back to pre-TCJA. Personal exemptions are going to return, but the standard deduction is going to be a lot lower. So that's going to bring back opportunities to itemize on your taxes. But make no mistake, for most people, their taxes are going to go up. So be preparing for that. Also, increase of the estate and gift tax exemption. Right now, it's currently about $13 million per person, $27 million per couple. That's basically going to get split in about half if it goes back to old levels. So it's about $7 million per person, about $14 million per couple. And then charitable giving is probably going to be a landscape that changes with TCJA as well. So that's just something we're thinking about and helping clients prepare for.
Perfect. Thank you. I will go down as saying that, so my forecast, 2024 will be known as the year that the Fed accomplished the impossible, soft landing or no landing. So remember that when we meet next year. Thank you. That concludes our part of the roundtable. We'd love to take questions if you have any.